You might want to start investing and make sure that you feel really confident and comfortable with what different investing terms mean. Or maybe you've been investing for the long term, but there's still some jargon that you simply don't understand. In today's video, I'm going to be going from A to Z of investing terms and explaining each one to you and giving you some examples. I will also timestamp all of the different terms below, so if you already know what something is and feel that you want to skip on to the next one or the next one after that, then please do feel free to do so. Also, if you get to the end of this video and you think that some terms that I've missed out from this video or you still don't quite understand, then please do pop your question or comment in the comments down below and I will try to get back to you. Okay, so starting with alpha. This is sometimes referred to as a measure of outperformance. This is the return from a portfolio or security in excess of a risk-adjusted benchmark return. For example, if you bought a stock and it went up 15% and the S&P 500 was the benchmark that you were using and that went up 10%, then your alpha would be the difference between the two, or 5%. Okay, our next term is asset. So an asset is a resource with economic value that is owned or controlled by an individual or a business. There is the expectation with an asset that it will provide future benefit. Assets allocation. This is the distribution of investments across categories of assets such as equities, bonds and cash. The Bank of England, sometimes called the BOE, this is obviously the central bank in the UK. The base rate. This is the minimum rate at which banks will lend money to individuals. This is currently set at 5%, however this is reviewed regularly, so this will change in the future. Bear. An investor who believes the market or a particular investment will fall. Investors can be described as being bearish. Benchmarking. The process of comparing the performance of a portfolio or fund against some target. The target may be an index or the average performance of a similar portfolio. Beta. The relationship between the returns on a stock and returns on the market. Beta is a measure of the systemic risk of a security or a portfolio in comparison to the market as a whole. Bond. A debt security issued by an organisation such as a government or corporation. Bonds pay regular interest and repay their principal or face value at maturity. Bull. So this is the opposite to a bear that we were talking about earlier. A bull investor believes that the market in general or a particular investment will rise. Chartist. This is a person or individual who studies charts of movements in financial and economic indicators to predict how a security price will move. Chartists look for price patterns and trends based on historical performance to identify signals based on market sentiment and psychology. Commodities. These are any items that can be bought or sold. They're usually physical items. So think about things like gold, silver, oil, sugar. Those kind of things are commodities. Coupon, the regular payment made on fixed income securities. Crashes, this is obviously something we don't like to see in the market, so that is a sudden large fall in asset prices, for example, like what we saw in 2020. Delta, the sensitivity of an option premium to a change in the underlying security price, measured on a scale of 0% to 100%. Developed markets. Now you might see when you are investing, you might be investing in developed markets or emerging markets or a little bit of both. So developed markets are countries that are most developed in terms of economy and capital markets. The country must have a high income, but this also includes openness to foreign ownership, ease of capital movement and efficiency of market institutions. Dividend. So some people might focus on investing in stocks that pay good dividends or ETFs that pay very good dividends too. So a dividend is the distribution of profits by a company to its shareholders. Dividends are usually paid in cash. The dividend may be passed or cut if profits do fall. An example of a dividend paying stock is Apple, who currently pay an annual dividend yield of 0.43%. Emerging markets, this is essentially the opposite to developed markets. They're a developing or newly industrialized country with low gross domestic product per head. They can deliver high returns due to a rapid pace of industrialization, but can be risky due to elements such as poor legal protection, currency, custody, and settlement risk. Environmental, social and governance, which can be shortened to ESG. So this is an investment strategy focusing on companies that are addressing or working to address at least one of these three key sustainable investing dimensions: environmental, social and governance. Exchange traded funds. This is one of my favorite kind of investment, and I feature a lot of different exchange traded funds on this channel. So an exchange traded fund is a basket of different stocks. So something like the S&P 500 holds the top 500 companies in the US. It's an open-ended fund that aim to closely track the performance of a specified benchmark index, and they are bought and sold on the stock exchange throughout the course of the day. Now, very quickly, just to mention why I focus on investing in ETFs in this channel is because they do tend to outperform actively managed funds, and they also have very low fees when you compare them to actively managed funds. The Financial Conduct Authority, or the FCA, this is the UK regulator responsible for conduct issues across the entire spectrum of financial services. Flotation, the first issue of shares by a company of a stock exchange, an example of an initial public offering or an IPO. Foreign exchange, or FX, this is the name given to the general aspects of currency trading. Gamma, the sensitivity of an option's delta to a 1% move in the underlying security price, i.e. the rate of change of the delta or the delta of the delta. Gilts, these are simply bonds issued by the UK government. Gross margin, a company's total revenue minus the cost of goods sold, i.e. gross profit, divided by its total revenue, and this will be expressed as a percentage. Initial public offering, or IPO, this is the first issue of any class of security. Intrinsic value. This is the economic value of an option if it were to be exercised now. Intrinsic value cannot be lower than zero. Liability, something that an entity owns which is settled over time through the transfer of economic benefits, i.e. money, goods or services. Current liabilities are due to be paid to creditors within a year, and non-current liabilities in more than a year. Liquidity, the ease at which an asset can be converted into cash. Price to earnings ratio, or PE ratio. You might see this coming up a lot when you are looking at investing, and the price to earning ratio measures a company's share price relative to its earnings per share, or EPS. PEs are used to determine the relative value of the company's share, either against its own historical record or relative to its competitors within the same industry. Profit margin, the amount by which revenue from sales exceeds costs in a business. It is calculated by dividing a company's total revenue minus total expenses by its total revenue. This is expressed as a percentage as well. Short squeeze, now you might have heard about the GameStop short squeeze in 2021. This is where a group of retail investors drove up the price of GameStop stock, causing major losses for short sellers and financial consequences for lots of hedge funds. But a short squeeze in definition is a rapid increase in the price of a stock, primarily caused by an excess of short selling rather than being driven by the company's underlying fundamentals. Speculation, a risky investment strategy that involves taking positions in financial instruments in order to take an advantage of price fluctuations in the market, with the aim of making a very quick but potentially risky profit. A stakeholder, any person with an interest or concern in a business. For example, owners, directors, managers, and employees, or if you think about it externally, it would be prospective investors, financial institution, or government entities. And finally, we have volatility. This is the measure of the probability of an asset's price moving, usually calculated as an annualized standard deviation. And when I look at volatility for different investments that I talk about on this channel, we are always looking at the standard deviation. So where all else is the same, you're looking for a lower standard deviation with an investment, as it indicates lower levels of volatility. So there you have it. There's a glossary of some investing terms that you may have already known already, or perhaps you've learned something new today. If you do feel that I've missed out any major investing terms, or you'd like a follow-up video on this with those terms included, then please do pop any comments in the comments box down below. And if you've taken any value whatsoever from this video, or even learned one new thing, I would really appreciate it if you could like this video. Thank you so much for taking the time to watch, and hopefully like and subscribe, and maybe even comment too. I really, really appreciate it. Now, have a really lovely day. Bye bye.